Something huge just happened in China, and almost nobody noticed. While everyone was distracted by mainstream headlines, silver crashing, Russia deals, Bloomberg noise, China quietly made a move that could reshape the entire gold and silver market forever. This wasn't a rumor. This wasn't speculation. This was an official government strike. On February 13th, Shenzhen regulators released a joint announcement so aggressive, so serious, that it sent a message to every precious metals trader on Earth. If you are trading gold or silver without real delivery, you're now a criminal. Welcome to the hidden story behind the metals market. For decades, gold and silver have been traded in two completely different worlds. One world is physical, real bars, real coins, real metal that must be mined, refined, transported, and delivered. The other world is paper, contracts, digital positions, leveraged bets, and promises that the metal exists somewhere behind the scenes. And the biggest problem is this: the paper world has grown far larger than the physical one. Every single day, massive exchanges in New York and London trade volumes of silver and gold that are dozens of times bigger than the amount of real metal available on Earth. Most investors don't realize it, but the price they see on their screen isn't always determined by physical supply and demand. It's often determined by how many paper claims are being created, traded, and manipulated by institutions with enough capital to move markets. This creates an illusion of endless supply. Paper contracts can be created instantly with a keystroke. They can be bought, sold, settled in cash, and rolled over without anyone ever demanding delivery. That means the market can appear stable even when physical metal is tight. But the moment too many people want the real thing at once, the entire system begins to crack. And this is where the danger becomes real. Paper trading doesn't just distort pricing, it encourages speculation, leverage, and risk that most retail participants don't fully understand. People think they are investing in gold or silver, but in many cases they are simply gambling on price movements inside a system where delivery is optional and rules can change overnight. We've seen this dynamic play out repeatedly. When metals rise too quickly, exchanges raise margin requirements, forcing leveraged buyers to liquidate. Prices crash, not because physical demand disappeared, but because paper positions were wiped out. Retail traders get burned while large institutions survive. This is why paper precious metals markets are so controversial. They dominate price discovery, even though they are not backed by real metal in equal proportion. The result is a global system where the price of gold and silver is often set by promises instead of physical reality. And when those promises fail, the losses can be catastrophic. Now here's where the story becomes far more serious than most people realize, because what just collapsed in China isn't some strange local scam that only affects one city or one group of investors. What happened in Shenzhen is a warning sign, a signal that the entire global precious metal system may be entering a new phase. At first glance, this looks like a simple crackdown on fraudulent platforms. A few bad actors running fake gold trades, regulators stepping in, case closed. But that's not what this is. This is something deeper. China didn't just shut down a company. They issued a message that challenges the foundation of modern gold and silver trading. The truth is, the structure behind these platforms is not unique to China at all. Selling exposure to gold and silver without delivering real metal is the backbone of paper markets worldwide. Contracts are traded in enormous volumes, often settled in cash, creating the appearance of supply that may not actually exist. Leverage amplifies the bets. Speculation replaces ownership. And most participants never question whether the metal is truly there. So when China suddenly declares that trading precious metals without physical delivery is illegal, not unethical, not risky, but criminal, it forces a much bigger conversation. Because if that logic is applied beyond Shenzhen, it doesn't just destroy a few platforms. It threatens the entire paper-based pricing system that has dominated for decades. And here is what makes it even more explosive. China isn't only targeting the dealers. They're targeting the infrastructure, the apps, the mini programs, the software providers. Anyone who helped build these paper gold systems is now exposed to legal consequences. That's a level of enforcement most countries have never attempted. This isn't about fairness. China didn't act because they suddenly care about free markets. They acted because the collapse triggered chaos, protests, political embarrassment, financial instability right before the biggest holiday of the year. But intent doesn't matter. The consequences do. Because once you remove the paper alternative, investors are left with only two choices: stop participating entirely or move into real physical metal. And physical gold and silver cannot be created with a keystroke. They must be delivered. That is why this story matters far beyond China. If speculative demand is forced into physical buying, the pressure on global supply could change everything. To understand why China suddenly launched one of the most aggressive crackdowns in precious metals history, Shu Bay is just another neighborhood. It is the beating heart of China's gold and silver industry. Thousands of jewelers, refiners, wholesalers, and traders operate inside this one dense area. If gold and silver had a capital city in Asia, Shu Bay would be it. This is where physical metal moves, where deals are made, and where China's enormous demand for precious metals becomes reality. And in late January, everything inside Shu Bay began to unravel. A company called JWR Jewelry had quietly grown into one of the biggest gold trading platforms in the district. On the surface, it looked completely legitimate. Customers could open a mini program on their phones, see live gold prices updating in real time, and instantly lock in a purchase. It was smooth, modern, and appeared no different than any normal physical gold business. But behind the clean interface was something much darker. Customers weren't actually buying gold, they were placing leveraged bets. Instead of paying the full cost of gold, users only had to put down a small deposit, sometimes as low as 20 yuan per gram. That's only a fraction of the real price. The platform called this pre-priced gold trading, making it sound like an innovative way to secure metal early. In reality, no physical gold was ever delivered. No bars were shipped. No vault inventory changed hands. What customers were really doing was gambling on price movements. If gold rose, they could close the position and collect profit. If gold fell, they lost their deposit. It wasn't ownership. It wasn't investing. It was an unlicensed futures market running through a phone app, offering extreme leverage, in some cases up to 40 times exposure. And for a while, it worked perfectly. Gold kept climbing, and people thought they had discovered an easy money machine. JWR exploded in popularity. Influencers promoted it across social media. The platform advertised zero processing fees, guaranteed buybacks, and effortless profits. Investors from across China poured billions into the system because, on paper, everyone was winning. But systems like this only survive as long as confidence survives. Then January happened. Gold prices surged sharply, and suddenly thousands of users wanted to cash out at the same time. What followed was inevitable, a classic financial run. The platform didn't have enough liquidity to cover withdrawals. It wasn't holding real gold for every customer claim, because the entire business model depended on paper exposure, not physical inventory. Panic spread quickly. JWR responded by limiting withdrawals. Investors were told they could only withdraw 1 gram of gold per day, or roughly 500 yuan daily. About $70. That might sound small, but many customers had hundreds of thousands or even millions locked inside the platform. Imagine having your life savings trapped and being told you can only access $70 a day. The reaction was explosive. People from provinces all across China began flying into Shenzhen. Thousands gathered outside JWR's offices in Shu Bay demanding answers. The situation escalated into street protests. Police were called in. Investors confronted staff. Chaos spilled into public view, right in the center of China's most important precious metals district. Estimates of the damage were staggering. More than 10 billion yuan vanished, around 1.4 billion US dollars. Some reports suggested over 150,000 people were affected. Ordinary families, retirees, small business owners, all caught in a system they believed was tied to real gold. But here's the key point. JWR was not the only platform doing this. Almost immediately after the JWR collapse, another similar operation in the same area failed as well. Different name, same structure. Deposits, leverage, paper exposure disguised as physical trading. Investors once again traveled from other provinces into Shu Bay, demanding payouts that never came. Then the crisis deepened. A major silver dealer in the district defaulted on physical delivery. Hundreds of buyers were waiting for silver they had paid for, but the metal was never coming. Suddenly, Shu Bay wasn't just facing paper fraud, it was facing real delivery failures too. The entire district was spiraling into disorder, and the timing could not have been worse. This was happening right before Chinese New Year, the most important holiday in China, a period when social stability is politically critical. The last thing the government wants is protests erupting in a major financial hub during Spring Festival. So Beijing could not ignore it. Shenzhen regulators could not delay. And that is why, on February 13th, something unprecedented happened. 10 government departments came together, not one regulator, not two, 10, including the People's Bank of China, public security authorities, the Securities Commission, and market supervision agencies. They issued a joint announcement that amounted to a declaration of war. The message was simple: stop immediately. Any business running gold or silver trading schemes that involve deposits, leverage, deferred settlement, or price difference gambling without real physical delivery would now face criminal prosecution. This wasn't guidance. It wasn't a warning. It was an ultimatum backed by law enforcement. China had finally decided that these shadow paper precious metals markets were no longer tolerated. And Shu Bay, the heart of China, Su's gold industry, became the epicenter of a crackdown that could send shockwaves far beyond Shenzhen. Because when the world's largest physical precious metals buyer decides paper trading is fraud, the entire global system begins to shift. And this story is only just beginning. The Shenzhen announcement was not just another routine regulation. It was something far more serious, a line in the sand that China had never drawn this clearly before. The order was direct, aggressive, and impossible to misunderstand. Gold forward pricing, deferred settlement, leveraged trading through deposits, internet-based precious metals platforms, WeChat groups, mini programs, apps, websites. If your customers are placing money down, speculating on price movements and closing positions without ever taking real physical delivery of gold or silver, you are now operating illegally. Not unregulated, not under investigation. Illegal. And in Shenzhen, that now means criminal prosecution. That is what makes this crackdown different from anything we've seen before. China didn't simply announce tighter oversight. They declared that paper-style precious metals gambling disguised as physical trading is fraud, and fraud will be treated as a crime. But here's the deeper reveal. For years, this entire shadow market existed because of a regulatory vacuum. Gold trading in China fell into a strange no-man's land. One bureau assumed another bureau was responsible. The Securities Commission couldn't fully intervene because these schemes claimed to involve physical metal. Local regulators lacked authority over derivatives. Exchanges had no enforcement power because the transactions were happening off the books. 5 or 6 different agencies all pointed at each other saying, "It's not my problem." Everyone was involved, nobody was in charge, until the JWR collapse forced the government's hand. The void has now been filled, and it wasn't filled with warnings. It was filled with police enforcement and criminal law, and the crackdown didn't stop with the dealers themselves. This is the part most people are missing. China also made it clear that third-party technology providers are not safe either. The companies that built the apps, the mini programs, the trading software, the infrastructure powering these schemes are also legally responsible. In other words, China isn't just shutting down platforms. They are dismantling the entire ecosystem that allows paper gold trading to hide behind the appearance of physical business. Now step back for a moment and think about what this really means. Because what was happening in Shu Bay is not unique to Shenzhen. It's not unique to China. Selling paper exposure to precious metals while giving customers the illusion of ownership is something the global financial system has normalized. Western exchanges trade gold and silver contracts in volumes that dwarf the amount of physical metal that actually exists. Prices move, not because real bars are being bought and sold, but because paper contracts are created, leveraged, and traded by institutions with massive balance sheets. The spot price you see on your screen is often not a reflection of physical supply. It is a reflection of paper positioning, and when metals rise too fast, the rules change. Margin requirements are increased, leverage is crushed, retail traders are forced out, prices fall, not because demand disappeared, but because paper speculation was liquidated. China just witnessed the same dynamic inside its own borders and made a decision. This is fraud. This is manipulation. This is illegal. Stop now or go to prison. The United States has not done this. The United Kingdom has not done this. COMEX still operates as it always has. The same banks that have paid massive fines for precious metals manipulation remain dominant players in the market. No emergency crackdown. No 10-department joint order. No criminal deadline. China did not act because it suddenly cares about fairness. It acted because the collapse created chaos, protests, embarrassment, instability right before Chinese New Year. But intent doesn't change outcome. The consequence is the same. The second largest economy on earth just told its precious metals industry that if you trade gold or silver without real delivery, you are a criminal. And that forces Chinese investors into a new reality. If paper substitutes are banned, there are only 2 choices left. Stop speculating or buy physical metal. And physical metal cannot be created with a keystroke. It must come from somewhere. That is why this crackdown could matter far beyond Shenzhen, because it pushes demand away from paper promises and toward real, deliverable gold and silver. So here is the real question. What happens when the world's second largest economy pushes an entire precious metals market toward physical settlement only? Demand changes, pressure builds, supply tightens. And suddenly, 2 prices emerge, a paper price in New York and a physical price in Shanghai. We've already seen hints of this. Asian physical premiums have been running above Western spot prices for months. Dealers in China, India, Dubai, Japan have been quoting higher real-world prices than what your screen shows. 2 markets, 2 realities. China's crackdown is not just a regulation, it's a declaration. Paper metal is not real metal. And now in Shenzhen, it's not just wrong, it's a crime. If other cities follow, if Beijing makes this national, the entire global pricing structure could fracture. Physical buyers may finally take control. And that is something no paper market is prepared for. And that brings us back to the moment nobody noticed. February 13th, 9:49 a.m., 10 government departments, 1 announcement, a war on paper, precious metals. Most people thought it was just a local Chinese crackdown, But it may be something much bigger. Because when the world's largest physical metals market says no delivery means no legitimacy, that shakes the foundation of global price discovery. After Chinese New Year, the real test begins. Will Shenzhen be the first domino? Will other provinces follow? Will paper speculation be forced into physical demand? And if it is, where will that metal come from? Because unlike paper contracts, gold and silver cannot be printed. And the moment the world realizes that, the entire game changes. Drop your thoughts in the comments. Is China rewriting the rules, or will Western paper markets keep control? This is The Hidden Economy, and I'll see you in the next one.